Hi, welcome to this episode of Talking Tax with Alex. This is part 4 of our closely held insurance company series, and it's going to be the final episode of this series. In this video, we're going to look quickly about what this series is about, what each video in the series covered. We'll talk about the basics, the tax year, the structure of the taxpayer. We'll dive into the ruling, and then we'll end on some closing thoughts. So real quick, we've covered this in the 3 previous episodes. The court case we're analyzing is Reserve Mechanical Corp versus Commissioner versus the IRS. It's a 2-court case, so it went through regular court, tax court in 2018, and then it went through the appellate court, appeals court in 2022. So in the previous episodes, and I'll put a link to the episodes, the previous episodes here. We covered the basic organization structure and terminology of what a captive insurance company is about, and the IRS's position and recent actions. Then we began the court case analysis and looked at the taxpayer's insurance facts and the background. In part 3, we looked at the taxpayer's facts, such as what does the taxpayer do, how did the taxpayer come to arrange and create their captive insurance structure, and that's all covered in part 3. In part 4, we're going to end and look at the court's ruling. So really quick, as a refresher, the tax dates at issue are for tax years 2008, 9, and 10, and the deficiencies are from $145,000 to $168,000. So this isn't a multi-million-dollar case, but why it's so important is because it sets a precedent for captive insurance companies, and it puts into writing the law behind where the lines are when you operate a captive insurance company. So it is a really big case, even though the numbers aren't in the millions. As a reminder for the closely held insurance company structure, we have the taxpayers, Zombaum and Weichel, who own Peak Mechanical and Components Inc., which is their operating company. It's a mining company, and that services mining equipment and does stuff like that in Idaho. We covered that in episode 3. They created Reserve Mechanical Corp, which is reinsured by Pool Re. Pool Re is the backstop insurance company that is supposed to help mitigate the risk and diversify the risk, or distribute the risk for Reserve Mechanical Corp. So that Reserve Mechanical Corp isn't only insuring one company. That's the idea. So the backstop of Pool Re is supposed to be to cover Reserve Mechanical Corp in case something catastrophic happens and it can't cover what it needs to cover. Each year at issue, Peak Mechanical Corp paid Reserve about $400,000 for insurance, and Reserve is supposed to have provided insurance coverage for Peak. Captive insurance companies are created for the purpose of writing coverages that are generally unavailable or impractical to obtain in the conventional insurance marketplace. This is important because this is the heart behind why a company should create a captive insurance company. So a quick excerpt from the court case is, in cases where we had held that the captive insurer achieved risk distribution by insuring a sufficient number of unrelated parties, we also determined that the transactions with the unrelated parties were insurance transactions for federal income tax purposes. This quote's important because it sets the 2 definitions for why for how a captive insurance company will be deemed as a captive insurance company. 1, that it needs to achieve proper risk distribution. 2, that the transactions to unrelated parties were deemed insurance transactions for federal income tax purposes. So risk distribution and actually deemed to be actual insurance transactions for federal income tax purposes. Why is that important? Well, before the court were 2 questions. Was Pool Re a bona fide insurance company? And was Reserve Mechanical Corp a bona fide insurance company? So in determining that, the court runs through a series of questions. Was it created for a legitimate non-tax reason? Was there a circular flow of funds? Did the entity face actual or insurable risks? Were the policies arm's length contracts? Was the entity charged actuarially determined premiums? So, was comparable coverage more expensive or even available? Was it subject to regulatory control and met minimum standard or met statutory requirements? Was it adequately capitalized? So, there's one more. Did it pay claims from a separately maintained account? So, if you watched episodes 2 and 3, we covered a lot of this. And the court found that Pool Re was not a bona fide insurance company because it did not adequately distribute risk. That's in episode 2. And the court found that Reserve Mechanical Corp was judicially set up as an insurance company, but was not operating as a bona fide insurance company. And if we want to take a quick reminder, this is from episode 2, how Reserve was not operated as a bona fide insurance company. And we're not going to go into these in that much detail, but the main issues were there's singular carelessness. So the paperwork wasn't done correctly, and the insurance was done very sloppily. There's commercial insurance available to 6 of the captive insurance policies that were provided, even though captives are created for insurance that's supposed to not be readily available. Go figure. The premium pricing problems. So the pricing wasn't generated through industry standards and standard industry practices, I should say. There's no risk analysis. There's no data used. It was just based on sales. And then the claim handling. So the claims were not maintained from a separate account. There was only one claim. It was never investigated. There's no evidence submitted. It was closed and then paid on again. It was a whole mess. So, Reserve did not operate truly as an insurance company. Pool Re did not distribute risk, did not actually distribute risk. That part I can capture in a slide. Go watch episode 2. And then more to the point of Reserve not operating correctly as an insurance company, when they engaged Capstone to help them administer and manage it, it was basically just a turnkey program. The feasibility study was not done well. It was issued late. There was no discussion of any likelihood of risk. They never even looked at the peak's business operations. Singular carelessness, premium pricing problems, those issues originated at Capstone. So this means that Reserve wasn't actually operating correctly as an insurance company, as a proper insurance company would. And if you recall, the two things that a captive insurance company needed was to distribute risk properly and to operate with transactions that are considered insurance transactions for federal income tax purposes. And when the court went through the list of all of the issues, it found that none of them were met. So in finding that Reserve Mechanical Corp was not a insurance company, there's like a bonus, a double whammy kicker that came out of this. There's like an extra ruling that came out of it. And if we recall, in episode 3, Reserve Mechanical Corp was set up in Anguilla, which is not a U.S. territory or country, or sorry, it's outside the U.S. It's not part of the U.S. It's a foreign country, and so in setting it up that way, they needed to be an insurance company because there's an issue with the taxability of Reserve's revenue. Because if Pool Re and Reserve was not an insurance company, then the gross receipts received by Reserve are not deemed as insurance premiums. And so if they're not deemed as insurance premiums, they're not allowed to make an election under 953D to qualify as an insurance company. Therefore, Reserve Mechanical Corp is a foreign corporation, which is taxed at 30% on FDAP income. FDAP is an acronym to basically say passive income. So, or basically non-operating income that's not from the U.S. So basically, what this means is because Reserve Mechanical Corp was organized and set up outside of the U.S. and it was found to not be an insurance company, that the proceeds, the insurance premiums that it receives was actually deemed as just gross receipts to a foreign corporation, and that gross receipts to foreign corporation is then taxed at 30%, which is income that they did not, or sorry, which is income and tax that they did not report and did not pay tax on. So this is the double whammy. The arguments that Reserve made to try to get out of this was that maybe that these are capital contributions that that they made to the company, even though they did contribute $100,000 to capitalize it in the first place. We talked about that in episode 3. They argued that these are just non-taxable advances or deposits into the company, just balance sheet. They put loans into the company. Maybe they're just loans or gifts in general. They really tried to argue that if the money was not deemed as insurance premiums, that it was just some sort of balance sheet transaction that they put into the company. Finally, they tried to argue that if it was gross receipts or gross income into a foreign corp, that they were allowed to take deductions. And the court ruled against all of these alternative arguments because there was no timely information or any contemporary documentation to support any of these positions. And the final quote I pulled out, that I pulled out of the case was, Reserve was organized and regulated as an insurance company and is satisfied the regulatory requirements of its domiciled jurisdiction in Anguilla. It also paid a claim filed under one of its policies. However, it was not operated as a bona fide insurance company, and there was no legitimate business purpose for the policies that Reserve issued for the insureds. So the courts found that Reserve was, although it was legally set up as an insurance company, it was just not operated correctly. The feasibility study came out late. The policies that came out were too goofy and too unrealistic. There was no business purpose for any of this. It was just a tax dodge. So what are my closing thoughts? The lessons from this case are that we now know, we have a very fine definition for what a captive insurance company looks like when it's not done correctly. You can see that when it's not operated as a legitimate insurance company, it does not have legitimate operations, that the claims process isn't real, that there's no investigation into claims, premiums are not priced correctly, the paperwork is all sloppy. You can really see how the tax court ruled that this was not a legitimate insurance company setup. The second thought is, are captives still a good idea? This one, I think, is really going to be up to the taxpayer's level of risk appetite. I think captives are still a good idea for certain taxpayers, specifically those that are truly in businesses where they cannot get insurance. They cannot get insurance that's readily available on the market for a specific risk. And that's going to depend on each business for them to determine. And I think that a lesson from this case and whether captives are a good idea, I think captives are a good idea, more or a better idea, if the insurance companies are housed in the U.S. and they are U.S. insurance companies, so that you don't have that extra double whammy, that surprise of a foreign corporation if you lose your definition of insurance. As an insurance company, you're not hit with that 30% FDAP tax. So that's it for this episode. If you like this content, please like the video, subscribe to the channel, and comment or email me your thoughts. Thanks. Bye.